Hi, my name is Michelle, and I'm here with Mark Sorensen, the CEO of Royal Fund Management and 401k Maneuver, a firm with about 1.2 billion in assets under management. So, Mark, thanks so much for being here with us today.
Oh, you're quite welcome. I'm excited. Good to see you.
Yeah, absolutely. Okay, so we're going to talk today. I want to discuss target date funds or TDFs.
Okay.
Everyone seems to have an opinion about them. Are they good? Are they bad? And some people just don't know what they are. So I'd like to start out with you defining TDFs in layman's terms.
Sure. Well, a target date fund, really, Michelle, just like the name sounds, it targets to a certain retirement date. So, for example, rather than your money be invested as an individual based on your own goals, objectives, risk tolerance, and the like, you're kind of lumped in with your peers, so to speak, based on your age and expected retirement date. So the idea is that the younger you are, the more aggressive, right?
Sure.
You have time, you have a long time horizon for your money to work, your dollar cost averaging. Volatility is actually your friend during that time. But the idea of reducing risk and making the portfolio more conservative as you get nearer and nearer to your expected retirement date.
Okay. So I want to just talk about the positives and also the downsides to target date funds. Let's start with the positive. One of the things that I know people really like them because they are easy and they take a lot of the thought out of selecting investment options. So let's start with that.
Right. For those that just want to keep it very simple, for those that, and I don't mean this as a negative necessarily, but those that just don't want to be engaged
Sure.
with their 401k and their money, they feel like they don't know enough, they don't understand the language and the jargon of the industry or something. It can be perfect. You put your money there, you dollar cost average in it over long periods of time, and you don't have to be all that engaged with it,
Yeah.
with the idea being that it will adjust over time based on your proximity to retirement in terms of risk. So from that standpoint, there's something in the industry called a qualified default investment alternative.
Okay.
That's where, Michelle, if an employee, for example, doesn't choose what they want to be in when they enroll in a 401k, the company, the 401k, can actually default people into a certain type of investment.
Right.
And one of the things that's been common over the last several years, there's only certain types of funds that can be utilized as a default investment. And
Uh-huh.
usually it's a fund with some kind of balance that has stocks and bonds. So for example, a balanced fund like that could be considered a qualified default investment alternative, or QDIA, right? The What has really come on with the storm in over several years now is that the target date fund being the qualified default investment alternative. So what happens is a lot of employees get put in a target date fund, like a 2050 fund or a 2060 fund, because that's the based on their age, their expected retirement date, and they just kind of get stuck there and they stay there, and that might be fine. But I guess if we're starting with advantages, it's simple. You don't have to worry about it. You put your money there, you dollar cost average with your deferrals from your paycheck, and you don't have to know or do much, let's say.
So I have a quick question for you.
Yeah.
You mentioned there are only certain types of funds that people can be auto enrolled in. Why do companies auto enroll people in TDFs? Is that just because that's the type that you can? Like, is it best for people, or is something else going on here?
No, I don't think there's anything going on here. I think factually, a target date fund is just simply the type of fund that qualifies
Got it. It qualifies for
as a
that. Okay.
default fund for people who don't pick their own investments or what have you. For example, oftentimes if a 401k moves from one company to another, one custodian to another, and there's a blackout period, the money shows up.
Mhm.
Typically, the money is automatically defaulted to a retirement date fund. And then if the employee wants to, they can go in there and make their own changes later to choose other funds within their 401k investment menu. But what we find is that oftentimes people don't. They just stay with the target date fund because it's simple and easy.
Sure. All right. Well, let's talk a little bit about the downside or the negatives to target date funds.
Well, and I might share my screen here in a minute and show you just something statistically, but the idea of a target date fund is that you don't have to worry about it. We're going to set this glide path towards your retirement. We'll be more aggressive in the early years of your working life, more conservative in the latter years. But the proof of the matter is that target date funds generally do not do a good job of managing risk along the way. And for example, over the last year, it's kind of interesting. Not only did last year the market went down, but interest rates were going up.
Sure.
So even the bond portion of a target date fund was performing subpar as well, because when interest rates go up, bond prices go down. So in a market like last year, where there was really no hiding place, a target date fund, I would just generally say, doesn't do a good job of managing risk when the times are tough. The other thing, being a balanced type of fund, oftentimes, if you look at the fund menu in your particular 401k, and you look at the performance, generally speaking, you're going to find several funds within your investment menu that would have performed well or better. The problem is, do you have the understanding? Are you engaged enough to be able to look at your own 401k, maybe as often as quarterly, I think would be a good recommendation.
Sure.
And make changes based on what's working in the market, get out of what's not working. So again, the target date fund is easy for the person that just wants to know they've got this longer term glide path and they don't have to do anything. But I would suggest, and a lot of proof out there, that target date funds generally are going to underperform the general market when the market's doing well, and they're not going to do a good job of managing risk during times of market stress. But that doesn't mean over a long term they won't perform, well enough for somebody to meet their goals. But I do believe that somebody that wants to engage and look at what's available to them in its entirety within their plan menu, they're likely to do better over time.
Okay. Do you want to show us those examples, or you said you wanted to share?
Sure. Let me share my screen. The first thing you're going to see here is just the screen that shows the market. A little bit of weakness today. That's, I think, a good thing. We'll talk more about that if you want to. But in particular, I wanted to show this chart, and I just chose something randomly. You can see the screen okay, Michelle?
Yes, totally. Yes.
Okay. This, for example, is a Fidelity Freedom 2050 fund, which is designed to target someone that's retiring in the year 2050. Well, it's a highly rated fund. It's four-star rating from Morningstar, and that's fine. But if you look at performance, average annual total returns, we're seeing three things in this bar graph here. The first, the purple, is the fund itself. Well, let's just look at the last 10 years. It's averaged 8.63%. Not bad, right?
No.
However, the gold fund is actually a Fidelity 2050 composite index, kind of showing the average of all of these types of funds.
Okay.
In 10 years, it had averaged 882, a little bit better. But what I was referring to in my previous commentary, the blue is the S&P 500. The S&P 500 are the 500 largest stocks. It's the most followed indice. Still, people today follow the Dow Jones, but remember, the Dow Jones Industrial Average is only 30 stocks. One stock with a good or bad earnings report could make a big difference that day. So most people, compare performance to the S&P 500. Well, if you look at 10 years there, the Fidelity Freedom 2050 fund is underperformed the S&P 500 by more than 4 percentage points.
Sure.
Well, I guess I could do the math. I think we won't on this call, but you could imagine what over 10 years, or for that matter, a working life, what 4% more would do. So you'd have a much, much larger nest egg if you'd done as well as the S&P 500. But then, okay, it's more of a balanced fund. Maybe it manages risk better. If you look at 2022 was obviously a pretty poor year. The fund went down 18.27. It actually went down more than the primary benchmark, the S&P 500.
S&P, right.
So that's where I was saying it doesn't manage risk well on the downside, and yet at the same time doesn't capture the upside.
Right.
And there may be some unusually good target date funds that have done better than that, but on average, you're going to underperform in the benchmark over the longer period of time, and it's not going to be managed well for risk. I did just see, as I scrolled down, something interesting. This goes back to, well, at least I see 2014 here on the chart. I guess this goes back to looks like July of 2013, and it just shows that 10,000 invested in this 2050 fund would be worth, as of July 31st, $19,663.
Yeah.
Whereas the S&P 500 would be worth $27,299.
Yeah. Big difference.
Significant difference in underperformance of the indices. I had another chart I wanted to show Michelle. Okay, to show that now as well?
Yes, please do.
So, as I said, if somebody wanted to really engage, nothing wrong with a target date fund for a person who just wants to keep it simple and doesn't want to engage.
Sure. But
for someone who really wants to engage, learn, try to do better for themselves, I want to show something interesting. This is just an old statement of a 401k that I happen to have on my screen with no names on it. And I want to show you something interesting. If you look here, maybe I can blow this up a bit.
Yeah, that would be great. A little bigger. There you go.
If you look at the target date funds, or at Voya, they call them life cycle funds, and these are all Vanguard. This was a period of time, by the way, from April 1st of 2021 to June 30th of 2021.
Okay.
The timing doesn't matter that much. I'm here to make I want to make a broader point. But in that period of time, or as of the end of June of 2021, if you look at the target date funds and you look at 1 year performance, you'd say, wow, I'm doing really good.
Sure.
Shorter the target date fund, the more conservative, right? You're closer to retirement.
Right.
If you're going to retire in 2050, the 1 year performance was up 36.5%.
Yeah.
And I can see how somebody would be very happy, and they should be.
Sure.
But it's interesting, if you look at this retirement 401k retirement statement, and you look at the other funds that they have available to them, the 1 year returns are, I'm going to round off, 41, 59, 43, 47, 42. Here's one that was up almost 71%.
Jeez.
In fact, almost every other investment option outside of the target date funds in this particular 401k performed a lot better than the target date fund. And so that's the point I was making earlier, Michelle, is that nothing wrong with a target date fund. It's simple, it's easy. But for those that really want to engage and try to do better longer term, if you look, I would in fact challenge people that watch this video, go to your HR director, or maybe it's in your statement like I was showing, and get the performance for every investment that's allowed in your 401k, and compare the target date fund performance or the target date fund that you're in, and look through the performance of the other funds on your statement.
Sure.
And I would imagine you'll find situations where you say, oh, wow, I wish I was in that. And that's just an example of what I said earlier of trying to be in what's working and out of what's not on a quarterly basis. It takes engagement, it takes some learning, but it's not that difficult, I think, to outperform target date funds over a longer period of time.
Okay, great. That was really good to see that. I think showing is always better than telling. It's pretty telling just looking at the percentages there on the page. So I have one last question for you. For someone who does want to get more engaged with their 401k and they're currently enrolled in a target date fund, like they look at it, they say it's not working for them, or they think it's not based on the statements. What do they do now? Is it as simple as just saying, I don't want to be in that again and making a phone call, or what advice do you have for people?
Well, it's interesting. There's a lot of studies out there, Michelle. There was one from Vanguard. There was others that show that, with no guarantee, we can't make guarantees, but
Sure.
that show that the expectation is, and I think some of these were pretty long-term studies, that professional management could potentially add as much as 3% more a year.
Yes.
Well, 3% compounded over a long period of time is a lot of money.
A lot of money.
But you know what? I always say, look, as a professional manager myself, I always kind of joke that I can't guarantee I do better than somebody else. The market's the market, right?
Right.
But the odds favor, with 42 years of experience, the odds favor that I would do better.
Sure.
So, there's a lot of investors that find themselves in a target date fund and might want to engage with their plan and see if they might be able to do better. They can learn it on their own. There's a lot of information out there today in the days of the internet and Google searches. Do your homework, learn, read, take a class, whatever you need to do. I do believe that even doing it yourself with a little study, you might be able to, at least it helps you engage, right? I would also suggest, though, that professional management of your 401k is something that wasn't available all that long ago.
Sure.
Really. There are a lot of professional management platforms that are very much like target date funds. They still manage money based on age and expected retirement date. But there are firms like ours, quite frankly, our 401k maneuver platform, where we take into consideration somebody's risk tolerance, their experiences over time. For example, you could have two people the same age, same expected retirement date. One of them, for whatever reason, has to catch up. The other one is fully engaged, their 401k, and done a great job, and they're at the point in life where, near retirement, they just want to preserve what they have. So one of them probably needs to add risk, or they're never going to catch up. The other one wants to be conservative. They're the same age. Sure. They have the same expected retirement date, but they're very different. They're very different as individuals, which is one of the problems I see with target date funds that put you in a peer group with people your same age and expected retirement date. You could go to 401kmaneuver.com and explore our website if you want to. There are others, but what we do is we take a look at our clients' 401k accounts every quarter, and we rebalance them. What does that mean? Well, there's two big decisions that we make every quarter. The first are current economic and market conditions.
Sure.
How much exposure should we have to the market in the first place over the next 90 days? Yeah. The second decision is for whatever percentage we think should be equity or stock market, if you will. We want to try to be in what's working and out of what's not. It's similar to that chart I just showed, and I'll look over there. That particular time frame, the mid-cap value fund was up 70%, where the institutional international fund was only up 30%.
Right.
Well, if we think mid-cap value is the place to be, then we're going to try to be in mid-cap value. And that's what I mean by trying to be in what's working and out of what's not from a momentum standpoint. But I would encourage people, whether you do it yourself or whether you consider hiring a professional management, at a minimum, we've shown you that there can be a significant difference in performance over time from a target date fund versus other options you might have in your plan.
Yeah, it can be. I mean, it's the overtime. You're the one who taught me time plus consistency equals wealth.
Absolutely.
It's true.
Anybody can get rich. The younger you start, if you're consistent with your investment and you do that over a long period of time, anybody can build a big nest egg. The problem with most of us, and I'd encourage younger people that might be watching this, most of us didn't start thinking about planning for retirement until we turned 50, right?
Yeah. 40s or 50s.
I would encourage you to start now, and time and consistency of investing can make anybody wealthy in terms of nominal terms anyway.
Yep, absolutely. All right. Well, thank you so much for this conversation on target date funds. I encourage anyone who's made it this far to get engaged with your investments, because this is your future, right? However you do it, whether you get professional help or you do it yourself.
Right.
All right, Mark, before we wrap this up, is there anything else you want to say on target date funds, or you think we've covered it all?
No, I just want to say, I think this is a very important subject.
Yeah.
I love what I do because we try to help as many people as we can. And I think there's a lot of America's employees that need help with planning for retirement and making sure they, it's not just a hope and a wish,
Sure.
that they actually plan for it. So I think very important topic, and thanks for the interview. Appreciate it.
Yeah, you bet. All right, everyone, go check out 401kmaneuver.com. Thank you so much, Mark, for all of this. And thanks to everyone who watched.